sorry we could not give you that 5 minutes break we were planning, but then the discussion was such exciting between Ajay and Sandeep. We really didn't feel that we should break into that. But then moving on, well, our next orator is a global leader with more than 20 years of experience. He is leading professional and financial services, and he's a passionate advocate of diversity, inclusion, and coaching for successful people outcomes. Many of his causes, include inclusion and diversity, and they have been really successful so far. He takes pride in being a change agent while delivering large strategic initiatives and managing complex consumer demands. Well, please join me to welcome Mr. Fazal, who will share his insights on how financial services are coping in the new normal and lenses of leadership as firms look to the world post-COVID. Over to you, Fazal.
Thank you very much, Harshika. I'm not sure who you introduced because that sounds like someone really good, and I don't think it's me. My daughter is standing right behind me, and she's giggling because she knows that none of it is true, right? Thank you very much. I was listening in to Sandeep's session, fascinating. I have lots of views on the discussion, whether it's crisis, whether it's AI, etc. But this is not about agility. This conversation is going to be a step back view of banking, and really kind of, if you peer behind the curtains on banks and how they normally operate and how they are forced to operate during this crisis, and where they're going from here, right? Because it's a very sobering topic, I thought I'd start by something funny, right? So obviously, did more than 50 hours of research, went down the YouTube rabbit hole, and saw many thousands of videos, right? I paid my research assistant right here $50 to come up and select one. So I chose one which I think speaks to me more than anything else.
Let's do this! Everybody on the ground! This is a robbery! Don't move! Hey! Get down and stay down! Don't move! The money! Open the vault!
Mr. Johnson? Eric Johnson?
How does she know your name? I don't know.
Your mobile app pinged us when you walked in. Looks like you were on our website and thinking about buying a house.
You moving out, man? I need my space.
Eric, you may think you can't afford a new home, but we have some amazing new rates. I could text them to you.
Oh, those are fantastic.
And Mr. Davis?
Yeah, it's me.
Did you click on one of our emails about consolidating your student loans?
Maybe.
Tim! What's the matter with you?
Oh, well, we can help you with that too.
Hey, what are you doing? This is a robbery, remember? We gotta go! Come on!
Can I lock those rates in on the app?
Well, of course you can, sugar.
Oh, great. Let's do this!
Well, as you can see, right, that is the new reality of banks. They know more than they should. Next to your doctor, they probably have more information than they actually need to. They're constantly selling you things that you either need or don't need. And they are, in some respects, using the nudge theory, right? Every action you take is information for them around what they think you need. But today what we'll talk about is banks in general, and some of it maybe sounding a little basic, but it's important to anchor ourselves on how banks operate. The 2008 financial crisis, right? Going back to the previous conversation you had, we tend to solve today's crisis with the tools that we used in the last crisis, right? That is the de facto way that leaders operate. And so a lot of what banks are doing today has roots in what happened and how they operated in the previous. Basically, because it's very early in the game right now, we'll just look at the impact, the regulatory response, and what banks are doing to fight back. Because these are early times, they are trying to kind of marshal their own approach to it, but in some respects, their hands are forced. So very quickly, right? Banks are everywhere. People talk about retail, commercial, investment banks, different types of banks. At the end of it, all of what banks do, irrespective of whichever type of banks you may have, is they lend money based on deposits or based on borrowings that they have from each one of us. So we deposit into a bank, they lend it out, and then they make money off the difference between the two interest rates of what they pay us, which is very little, and what they pay, what they get from anybody who borrows money from them, which is quite a lot. So banks fundamentally make money in two different ways. One is net interest income, which is a difference in interest rates between what they borrow versus what they lend. And second is fees, your checking accounts, your overdraft fees, for investment banks, the trades that they accomplish, everything is fees, right? So the incentive becomes on two fronts. One, how do I, in some respects, maximize the differential between the interest that I pay my deposit holders versus what I lend to anybody else? And secondly, how do I make more fees? On the interest side, some of it is curtailed because they depend on the central banks, etc., to set the interest rates. So some of it they have very little flexibility on, but they have a lot of incentive to maximize fees. And so the more loans they make, the more transactions that they do, the more fees that they do. The more a person defaults, etc., the more fees that they make. So bankers were heavily incentivized, if you look at the top right, to invest, to make money using fees. So what the roots of the financial crisis is, very simplistically, whether it's mortgages or any type of asset, you took a mortgage loan from your bank, the bank effectively for 30 years was waiting for you to pay out month by month, week by week, whatever frequency you had. And in some respects, if you didn't pay, that became what we call as a net non-performing asset, NPAs, which you hear a lot of in India, right? But they are in some respects waiting. So then some smart investment bankers said, why should we wait? Let's monetize this risk. So rather than us waiting for someone to pay me back, I'm going to take everything that is due out there and I'm going to create a security and going to sell it out in the market, right? So that became something where you took the risk from what the bank had and then you syndicated it out to many different people who had nothing to do with the bank or with the original mortgage itself. They were just buying an instrument that they thought, just like a share, that they thought would give them a guaranteed return. And the underlying bias or the underlying psychology is housing prices will never go down, right? You buy a home, right? You expect the price of the home to keep going up, right? So in this cycle, what will happen? The banks are incentivized to write more loans, and the investment bankers are incentivized to take those loans and securitize them and sell it out in the market. At a certain point, there's only so many loans you can do. So banks started giving out loans for third, fourth, fifth homes to people who had no income in some respects, and they had zero collateral loans, right? And that's what is called a subprime crisis, right? And the reason this started shooting up is the incentive worked in such a way that the risk started getting offloaded more and more and more to people who had nothing to do with it, right? And I'll just show you a video which explains the craziness of the subprime crisis in full bloom.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up and up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. Bet you 50 million she wins, and I'll give you 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win, so I want a great payoff.
How about 20-1?
Deal.
And this will go on and on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
So this is what happened, right? You had small governments in Germany buying mortgages or buying securities about mortgages in Florida that they knew nothing about. So you had CDO, CDO squared, you had lots of different elements of the crisis that just bloomed from there, right?
Okay.
So this was the last recession, right? The financial crisis, as it's called. Housing prices went down 32%. Unemployment was over 10% for more than 2 years. The Fed actually spent more than $1.5 trillion to rescue various financial institutions. AIG alone received $150 billion bailout because of this contagion where people had CDOs and CDO squareds and CDO triples, and it just bloomed overall from a risk standpoint. So the regulators said, you know what, never again. They were blamed for being too slow. They were being blamed for acting too late and being too lax. They said, we are banning all risky products, and that's what the Dodd-Frank Act is about. We're going to make sure that banks focus on basic lending and lend to who you can pay back, right? And so going back to the conversation we had, this crisis and how it came to be and how regulators acted and the fall of Lehman, the fall of Bear Stearns, and fall of all these institutions really informed how regulators are operating today in COVID. Though this is not a crisis that the banks caused, the banks are right in the middle of this in terms of how they operate. In parallel, you had the rise of fintechs. As developing economies particularly started moving to a more mobile first economy, right? The fintech started offering services to them and chipping away from what traditional banks do. The benefit really is the fact that they are easy to use and they solve a particular problem at very low cost, right? So as you can see up above, China, India are among the leaders in adopting a lot of these payment wallets, fintechs, borrowing by small companies, and really have led the bloom in how fintechs operate. Right now, there are more than 20,000 fintechs globally offering all kinds of services backed by venture capital of nearly 750 billion, and more are getting added on a daily basis. So banks have two challenges. The way they made money is going away. They have this competition with fintechs and big tech on the side that is starting to erode whatever basic services they offer, right? And the way they operated is by using legacy technology, legacy ways of thinking, really old style approaches to it. So they woke up to this twin sort of challenges and they said, we need to do things differently. So the leader banks, the big banks who spend more than $1.5 billion in technology on a yearly basis, have invested heavily over the last 5 years on these particular priorities: cybersecurity, AI platforms, particularly in the wealth advisors, elements of things, cloud, agile, blockchain, cryptocurrency. You see JP Morgan and others leading crypto type of new products that are based on it. Predictive analytics is a big focus, and automation as such. So they have responded to both the push from the regulators as well as the challenges from the fintechs and big tech by investing heavily in their own technology. And they want to think of themselves as, in some respects, a new bank coming out of all of these crises and operating in a way that changes the paradigm for themselves and the way they operate. Right? Their focus is building personalization at scale, right? And we'll come to that, but banks today are focused on what they call a customer of one, right? It is you as an individual, your needs and desires are what banks are focused on. And the more they can personalize the story to one particular individual, the more foundation they have. So everything they're doing, digital advisory, analytics, etc., is focused on that customer of one and that approach, right? So this is all the preview, right? And then COVID hits. Very simplistically, as we are looking into the crisis, and this is the data for India, you're starting to see how systemic every industry is getting hit, right? There isn't an industry that is saved. And if you look between last year and this year, health is obviously less hit compared to others. Airlines and hotels obviously most hit. But it's significant, it's pervasive. There isn't a place to hide. There isn't a place to make money in this time. Every place you go, there are significant challenges, both in terms of employment of people who are affected by these sectors, the share of GDP, or who they've extended loans to, right? So 69% of the Indian bank's loan book are in industries that are affected quite heavily by this crisis, right? So it's not going to work in a way where they can say, you know what, I can do this in a different way and I can operate in a different way, right? They have to start to wait this out and be ready to take huge losses from the way they operate today. Every bank in the last quarter has announced reserves. That is basically they are putting money aside to handle losses, all in the order of 400, 500 billion, right? And that's just a ratio of what they need to tide over the next few months compared to how this will play out in the years to come, right? I don't, this is obviously a busy slide, but what the implication of this is everybody's throwing everything, right? What regulators took 3 years to do in the last crisis, they have done in 3 months. They have exhausted it. They have cut rates. They have eased your borrowing challenges. They have tried to offer additional liquidity, which is basically the ability to move money around in the market. They're running out of bullets, and that's a very important point to note. They have used everything that they used in the last crisis, and at this point in time, they are nearing the point where they have no more bullets to fire, right? So the situation has to get better for these things to take hold because the regulators have very little room to maneuver going forward, right? So how are banks responding, right? So first and foremost, the big lesson that banks took away from the last crisis is they have to wake up to their societal obligations. If they don't treat themselves as part of society and what they need to do for society at large, they are in big trouble. Their reputation and brand depends on the fact that they are going to be sort of empathetic and sympathetic to people around where things are. They can only do it to a certain extent. And as you can see, we are in an environment where what people's debt is going to rise a lot faster compared to what their incomes are, right? Incomes, people are going to get laid off, are getting laid off, while their debt keeps increasing. So how banks operate in that environment becomes quite important, right? In the US, and I'm sure everywhere else, there's a huge conversation on inequality and how past biases have affected banking in particular in terms of who they offered loans for, what they've done. So there's a big push to address inequality as part of this crisis going forward as well, right?
Just a quick reminder, we have 5 minutes to wrap up and then we move to Q&A.
Understood, absolutely. Thank you, Harshika. All right, I'll do it. So are you digital yet, right? So basically the big issue right now is, who is leading digital transformation companies, not your CEO, CTO, it's COVID, right? Your customers are afraid to walk into branches. Everybody's inclined to use the digital app. They are worried about making their loans. So every single bank is focused on being digital or having digital first as their narrative. So whatever banks spent in the past, that's working out for them now. Cybersecurity, AI, ML, and cloud. If you have those skills, hey, every bank wants you. Automation first, the new role, and digital distribution of products. It's the branch experience is dying, and it's going to be dead very soon, right? So everything is going to be digital in terms of the products you want to loan. It's your app. That's going to be the way things work going forward. And the banks that have invested heavily are paying the benefits of it, and the laggards are really struggling because they can't ramp up fast enough to get there, right? Collaboration, not competition. Banks have realized that they need to collaborate with big tech, with fintech. They are not in a position to compete. We'll come to fintechs, but they are all talking about open innovation, more collaboration. What you see on the right is BBVA, where basically BBVA just is a skin. Everything under BBVA student loan platform is done by someone else, right? And they have all these microservices and smaller firms providing capability for them that they just front end for their customers, right? And that's going to be the increasing model that banks do. We heard about this big Google Deutsche Bank deal that happened a couple of weeks back, Allianz and Microsoft. So big tech and banks are starting to come together and join forces to effectively create a new financial services future for both of them, right? Fintechs have flourished during this COVID time, but as you can see in the bottom left, their runway is starting to run out in terms of money that they have. A lot of fintechs are saying that 6 months is the maximum that they have. So they are rushing into the arms of traditional competitors. I had a conversation with 2 banks last week who said that they are able to now buy fintechs at 50% of the valuation that they had last year. And they are saying that, we are pushing for 40 or 35, and they are desperate enough to say yes. So fintechs are running out of money, and this has huge implications for people who've jumped on the fintech bandwagon, both in terms of jobs as well as people from customer standpoint. Blitzscale and Blitzscale, what we mean by that is, this is a time to look at your product portfolio and say, this is working, let's blitz it, let's scale it very quickly. And this is not working, let's shut it down. On the people side, let's give them new skills, particularly your branch staff. They will need to adapt to this new environment where they are not going to be customer facing anymore. And they're going to be virtual, they're going to have chats, they're going to be on video rather than in person, and they need new skills to adapt to it, right? And last, from a bank employee standpoint, right? Your employees matter more than ever. Work from home is challenging. While it's helpful, there's a lot of stresses that come along with it. And there's a lot of research that says your stronger connections are strengthened. It's the people that you talk to every day, the people that you're part of your team, that connections are strengthened. But your weaker connection, the people you used to run into the hallway, the people you used to have random conversations with, that connection is weakened, right? You don't talk to those people anymore. And for banking, it's a very crucial element of what is someone else doing, and how are they operating in this environment, right? So navigating this is going to be quite challenging overall, right? So I'll end here. Agility requires stability. You're all agile professionals, but this is a time where people are psychologically stressed. So you have to understand that the stability and the comfort and the empathy that leaders need to give their customers as well as their employees is important, right? The second one is borrowed from Dominic Barton. You need to have a microscope in one eye and a telescope in another. As jarring as that visual is, it's quite important that people execute here and now and focus on what they need to do today. At the same time, have that view of that future. This crisis is going to end. It's going to take 2 years, 3 years. A vaccine will be found. Things will happen. Where will we be at that time? It's quite important that leaders have that vision and drive towards it. Otherwise, you're just solving today's crisis and you will learn no better. Build up your stamina, right? This is going to be a long drawn effort. This is, pardon the pun, not a sprint, it's a marathon. So building up your resilience and building up your core stamina is going to be quite crucial as you go That's it. Thank you very much for bearing with me. I know it's a very dry topic, but in some respects, I hope it's informative in terms of what the previous crisis is and what tools banks are using to solve today's challenges. Thank you very much. I'm happy to take any questions you have. And if they are
Thank you
tough
so
ones,
much,
my daughter's right here.
Fazal, I don't think in any way anybody is going to say this was a dry topic. I mean, this couldn't have been more fun than it did. All right, I have Vinaika who's asking a question. Vinaika, if you could unmute yourself, if you want to share your video, you could come on the video mode as well and ask a question.
Yeah, hi Fazal. Wonderful to listen to you getting a banking perspective on the current crisis. However, my question related to the 2008 crisis. I just wanted to understand, um, could it been prevented, or what are the lessons that we have learned that we can apply in future so that we can actually avoid these kind of financial crisis, not this kind of health crisis, which is not in our control, but financial crisis I am interested to know.
So the real lesson is human greed has no limits, right? It's a combination of greed on behalf of the bankers, the government officials and regulators who started relaxing regulations to allow for riskier and riskier products to come through, right? And in some respects, this is a classic psychology. So the book Nudge by Richard Thaler talks about it quite a lot, is that there's confirmation bias. People believe that a good thing will continue to last, right? And they believe in that positivity, and it reinforces their view that nothing bad is going to happen. So what has been different is the banks have a lot more money than they did before, right? So they are flush with cash. They don't have anybody to lend to. So if you have a good business idea, your bank is willing to lend quite a lot. Home mortgages in the US have fallen to less than 2%, right, which is quite a historical low in terms of what they're willing to lend to. So the banks have a lot more money, and the regulators are a lot more vigilant, right? If one thing that they are sure about is we will not have yesterday's problems, but we don't know whether we're going to solve today's problems.
Thank you, Fazal. Thanks.
Thanks, Vinaya. Anybody else who has a question, you could raise your hand and we could.
I see some questions on the chat window. Do you think the new rigor will last? Things will shift back to normal, to human tendency? So, it's my belief that inertia is the default behavior for most organizations. So that is, things will continue going in a certain way, or things will completely stop, right? The challenge for leaders is you can't operate in crisis mode all the time, right? Because it just exhausts people, and you cannot manage your energy quite well, right? At the same time, if you let your foot off the accelerator, then the change will remain incomplete, right? So there's a lot of research in terms of what we perceive as what will stick and what will stay as we come out of it, and it's going to be things that are completely changed, have reached a tipping point. The branch experience, etc., will completely change. There's no going back. There's absolutely no going back to where things are. But other things, there will be a slightly gradual pullback, right? Unfortunately, work from home, there will be some rationalization. It won't be one way or the other way. There'll be some pieces of it. So it will be a spectrum in which banks operate rather than one particular piece of it. Document signature. Actually, there are quite a few apps that allow you to sign virtually and credentialize you. So we didn't talk about it, but digital identity is going to be quite crucial for bank going forward. So know your customer and how things operate is all going to be based on digital identity. And digital identity is crucial for your contact tracing, and your health obligations anyway, right? So digital identity is going to become the future for how banks operate going forward. Any other questions? Anything else that I see?
I think that will be all. Thanks so much for your time, Fazal.
Thank you very much, Sanjay, first of all, and thank you for all of you listening to me graciously. Really appreciate it, and I wish you guys a good day. Thank you.